That is your best safety net. If you don't have some type of plan or written program or whatever type of thing you want to prepare when the markets are closed, okay, you're asking for trouble. Even if you're a day trader trading 1-minute scalps. I'll tell you why that's important. I find that even if I'm sitting there and scalping off of a 1-minute system, and we have a fun little scalp that we do in our office that we call the short skirt trade now. Okay, it's off of 1-minute charts. But I can tell you the odds of that strategy working before that day opens. And I will tell you that if we've just had a very large move in the market, like a 30-point or a 40-point wide-range day, a huge breakout or range expansion day, and the next day is going to be a consolidation type of day because the market, of course, alternates back and forth between the movement and then the consolidation, I can tell you the odds of that strategy will drop off 50% of its success rate working. All right? So that does impact me, even if I'm scalping off of a 1-minute chart, knowing the overall daily structure and conditions. Of course, I mentioned the ability to move on to the next trade, your ability to put the past behind you, and that's why, again, with stop orders, you just never want to take that one big loss. It's not the damage to your account. It's the damage to your head. Because once you do that to yourself, you know, you're frazzled, you're fried, you're shaken up, and you don't resume trading as you should. And that's what keeps you then from making your living. So all three of these men had four of them had three cardinal rules. First of all, don't overtrade. Now, overtrading does not mean the number of trades that you make. It doesn't mean that you're going in and out of the market 10 times a day. That's fine if you want to do that. It's the leverage that you use when you do that. I've been a professional trader for 19 years. 99% of the people that I see blow out of this business, and I've seen a lot, be it from the floor traders to CTAs to other traders, it's been a leverage function. Okay? It's trading 10 S&Ps on a $50,000 account. Okay? Or it's selling out-of-the-money puts. You know, if you're a big fund, selling out-of-the-money puts way too big, and there's not the liquidity there when you need to get them back, and they explode in your face in the advent of a big move. It's always the leverage that gets people. And you will see that in your own trading. If you look at your biggest losses, perhaps just ask yourself if they were your biggest positions in terms of number of contracts you have on. Because now you've got a vested interest in that position. All right? So that's something to think about. One thing that I do in my own trading is I have a strict unit size. I do X amount of contracts on every trade, period. And I keep X amount of contracts, and it doesn't matter if it's corn or bonds. All right? It makes it simple for me. It's X number of contracts. That's my unit size. I don't vary it. That keeps me out of trouble. So the leverage is what will ultimately take you out of the game. It's not putting in a stop on a one lot and letting it run 10 points against you. That's not going to blow you out of the water. The second thing, don't average a loss. Okay? I averaged a loss for 10 years and I got away with it. But it's a very bad habit, and I probably would have been a lot more profitable if I hadn't done that, you know. So all of us have done it at some times. I would say that's the biggest thing that I'm proud of in my own trading. In the last 6 years, I put on my bet. I leave it alone. It works or it doesn't. You know, if it does start to work, you can always scalp in the direction of the trend alongside your base position, but do not average a loss. All right, that's the second thing. These are the people in the 1900s that were writing this. And then the third thing, as I'm talking away, don't listen to others. All right? So, you know, if you sit there and you call up your best friend on the phone, or you talk to your broker, or you listen to CNBC, okay? Yeah, I see nodding heads, yes. It is so much harder for you to have confidence in your own analysis, number one, all right? And It's very hard for you to know when your trade isn't working. You'll get in the habit of starting to look for reasons or other factors out there to substantiate your position. You've got to learn to become an independent trader. Now, that certainly doesn't mean that you can't go take somebody's course or follow somebody's newsletter or something like that to learn from an educational point of view, the setups and stuff. I mean, I'll be the first to tell you, I've got something on the table there. We do this thing now. It's like on the internet, and I post all the stuff that I'm doing, all right, the setups that I'm looking and the trades that I'm taking. And I'll be the first to tell you that your ultimate goal should be, hey, watch it for a month, but your ultimate goal is to see the darn stuff for yourself, all right? And take the trades for yourself. And don't wait for somebody else to pull the trigger, So you've got to learn to be an independent trader and take everything you synthesized here this weekend, or if you already have your own program, one little refinement to it, and have your own program. Make it your own. Make it your own special business, your own game board that you play the game on, your own rules. And be happy about that. That is where ultimately you get the most reward out of the business. It is most satisfying if you have done the work or found the setup, take the trade and it works out, or manage it and it didn't work out, but you felt good because you saw it wasn't going to work out and you had your stop in place. And then, no matter what happens at the end of every day, whether you made money or you lost money, you can pat yourself on the back. That's the object of the game. It's a very similar principle to if you're systems trading. If you're systems trading, your object isn't whether you made or lost money that day, it's whether you followed the system or you followed the rules. And if you can say, I did everything I was supposed to do, it just wasn't my day-to-day, you can walk out of there with, feeling good that you did your job that day. And the same thing should be there on a discretionary level. Now, here's another interesting thing. Even though all these men were documenting these chart patterns, these wave price behavior sequences, all of them emphasized the importance that watching the tape played in their own trading. And I will say this, 95% of the big traders that I know do sit there and watch the price action. That's what watching the tape is. It's not sitting there and, watching a billion little ticker symbols go by at the bottom of CNBC. It's monitoring the price action. Perhaps for something unusual. Perhaps for an unusual spike in the market's movement or unusual volume coming into the market. Or, when you see the price go blip, 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 all the way up like that. That catches your eye. There's nothing wrong with that because that is the purest way to watch impulse. Impulse indicates the direction of the trend. Impulse is usually followed by more impulse. Okay, the odds are if you get a thrust in one direction, you will get a thrust in the next direction. Odds, high odds, not spikes, but high odds that you will get that impulse. So the eye is going to be the first to catch that impulse. And the reason I say that is because that's important, especially for scalpers in the S&Ps or discretionary traders, for learning how to duck out of a position that it may not be going against you in terms of taking a loss, but let's say you have a nice profit in it, and you're trying to push the profit. Okay, this is usually what I'll do. As long as it keeps on making impulse in one direction, followed by little continuation patterns or small pauses, you try and stay with the trade. And you'll usually get